The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Easy Money New England.
Oh, can somebody help us here?
We can, because we are real estate and mortgage professionals.
Here you go. It says come in and browse.
That's right. Come on in, listen up, and learn.
How long do you intend to browse?
In a short period of time, our panel will teach you some tricks that might make your house buying easier.
You don't ask her how long she intends to browse.
Might not be looking for a mortgage today, but we'll get you ready.
You don't look like browsers.
Are you looking?
No, what do browsers look like?
Yeah, maybe I'm half browse.
On his father's side.
This is Easy Money New England
Let's show the lady we're browse.
with your host, Brian
Hey,
DAmico.
look at us, we're browse. One more word out of you and he gets it, all right?
Welcome to another edition of our show, Easy Money New England, where every week we bring you money-making opportunities or money-saving ideas, all around the areas of real estate. And today with us we have Jordan Goodman. Jordan is known as America's Money Answers Man because he has been answering Americans' questions about investing strategies for over 35 years. He was a Wall Street correspondent at Money Magazine for 18 years, was a regular financial analyst for NBC News for 9 years, Marketplace Radio for 6 years, and is a regular guest on numerous national and local TV and radio shows. He hosts the weekly Money Answers radio show on the Voice America Business Network. He's an author of 14 books, including Fast Profits in Hard Times, The Dictionary of Finance and Investment Terms, The Barron's Finance and Investment Handbook, and Everyone's Money Book on Stocks, Bonds, and Mutual Funds. So, Jordan, welcome to the show.
Great to be with you, Brian.
So, Jordan, I was looking at your website, and you actually have a lot of, you've been on CNBC, you've been on CNN, you've been on Fox Business. So, I mean, you've been doing this for a long time, and, you consider really a financial guru, I would say.
I'll accept that. I have been doing this a long time. Well, there's a lot of resources, and I hope we're going to get that in today's show, that can help people really improve their finances dramatically. And I go out and find the best things I can and try to deliver that to people. And so what we're going to do is talk about strategies, but then specific resources that will help you implement those strategies. Some of them real estate related, some of them not. But I hope we're going to give a lot of value in today's show.
That'd be great. So, I mean, today everyone's thinking, the stock market seems a little high. I have my money invested in stocks. I have my invested in real estate. Everyone's looking kind of for that next bubble. And, if you have new money that you're looking to invest, I noticed that some of the strategies that you recommend for people to earn yields of 6% to 10% safely in an environment where banks pay 0% on savings accounts.
Right.
Can you speak a little bit about that?
Sure. So, if you keep your money in the bank, money market funds, savings accounts, CDs, you're pretty much getting zero, maybe as much as half of 1%. Yeah. But while the Fed Reserve has been raising interest rates on what you pay on credit cards, on student loans, on car loans, banks are not raising what you earn on your deposits. So don't expect this to change anytime soon, Brian. You're going to keep getting zero in the bank deposits. So you got to do something alternative to get a higher yield. Now, you're big in real estate, and I think real estate's actually one of the easiest ways to do that. Specifically, there are what are called secured real estate funds, where you can get an 8% yield quite safely. Minimum hold time is 1 year. Minimum investment's $5,000. And the full amount that you invest gets that 8% yield. And basically what they're doing is they're lending money in short-term, meaning 1 year, commercial real estate projects to help people renovate or improve their commercial properties. Could be apartment buildings, could be medical buildings, could be student housing, all kinds of different things. The people have a very long track record of having done this successfully. The maximum loan to value is 70%. So they're not lending the full amount of the property. The builder-developer always got a lot of skin in the game. And you can either take your checks monthly, or if you want to reinvest them and have your money compounding at 8%, that's a good way to go as well. So the website to find out more about that is securedrealestatefunds.com, or there's a phone number, 888-444-2102. So right there, Brian, there's a way for people to earn 8% instead of 0 in a very safe way.
Yeah, is that more like a real estate syndication where people are buying portions of the building and it goes in their tax return and portions?
This is a lending fund.
Just
this is not really an equity fund. This is a lending fund.
It's a lending fund. Okay.
Think of it as like bridge loans, kind of short-term bridge loans, and they're taking first positions on those specific pieces of property, and again, maximum 70% loan to value. So there's a real kind of a safety cushion there, and people are willing to pay a higher interest rate. Maybe they're paying 10 or something like that in order to get the projects done quickly. You know well, you're in the lending business.
Oh yeah,
it's really tough for people to get loans these days, commercial loans.
Right, but being in the first position, I think is very. I mean, it's very less risk when you're in the first position.
It is.
For sure. Yeah.
But the reason the borrowers are willing to do it is the banks give them such a hard time. It could take a year to get a loan, and then all kinds of paperwork and just tremendous delays and so on. These people can move much faster. If you have a project you want to get done, you want to get it done, not wait around for a bank to decide months later. So
and,
the speed
is the real estate
makes a big difference.
Is the real estate national in scope? So
about 30 different states, all of the country.
Okay.
So it's diversified geographically, and it's diversified by type, meaning they've got like a student housing, assisted living, retail properties. I'll just give you an example if it helps. The concept behind these funds is what's called collaborative lending, meaning the fund is like a partner with the builder developer to kind of make the project happen. They're not the enemy. They're like together with them, okay, as a partner. And in many cases, they've dealt with the same builder developers for many, many, many years. So I'll just give you an example of one they did recently. There was a guy that had a big house in a college town. I think it was Boulder, Colorado. And he'd been renting the house out to 2 students forever. He wanted to change the house, so he got a loan from the fund. And over a year, he completely rejiggered the house to make it into 4 apartments instead of 2. So a year later, he's got double the income he had before. The value of the house went up 50% or whatever. So he was willing to pay 10% to get the thing done quickly, and now his house is worth a lot more. So that's an example of kind of collaborative.
So these people investing in the lending fund, they're getting their 8% return. They're not getting any piece of appreciation, but they're getting 8% return, pretty much guaranteed.
It's called a preferred return. Actually, there's a little bit of appreciation. If that guy were to sell that house, he would actually share some of the profits from that appreciation with the fund. So they get a quarterly what they call a profit sharing distribution. It may be another point or two. It's not going to be huge.
Yeah, no, that's very interesting.
Starting at 8% is pretty good.
Yeah, no, pretty good for not having to be a landlord or get those calls in the middle of the night. That's pretty good.
Completely passive, correct? Completely passive. Right.
Today everything's a little frothy. So you say strategies to grow your money tax free with limited risk to build a comfortable retirement nest.
Right.
So no matter how the stock market is performing, most people, they have a little bit of stocks, they have some real estate, or they're trying to get into the real estate market. How can you do it where it's, tax-free is very interesting.
Okay, so these are insurance strategies. There's really only 3 ways you can do tax-free. Insurance, municipal bonds, and Roth IRA. Those are the 3 ways of doing it. But what I'm particularly referring to here is insurance, what are called index universal life insurance policies. The cash value inside the policy is tied to the stock market. When the stock market goes up, as it has been recently, your cash values go up. When the stock market goes down, your cash values do not go down. That's what I'm saying, without the risk of the stock market. Okay?
Yeah.
So it's a good long-term strategy. I have one of these myself. It's worked out fantastically. I keep adding a certain amount every month and just keeps growing and growing and growing. Now, what you do is you limit the upside to some extent. I think like 13% is the maximum in return for protection on the downside. So last year, the S&P was up about 25%. So I'm going to get only 13%, Brian, but I'll settle for that.
Now, is it a whole life? So is it a whole life policy or something else?
Not whole life.
No.
It's called Index Universal Life, what are called IULs.
Gotcha.
So because of its insurance, it grows tax-free.
Perfect. All right, that's something that we're definitely, and I'm gonna look it up myself for sure. And I'm sure if you're a listener on the show, Jordan's going to give us great opportunities to kind of look at the websites and take a look at his years of experience. I would definitely take advantage of it. And then something near and dear to my heart is, you talk about mortgage equity optimization to pay off your 30-year mortgage in anywhere from 5 to 7, all depending on how you utilize the system. Hodge Gill is one of the was one of the people that actually brought it to Australia, and I know him very well. And you also promote a mortgage equity system that is very similar.
It is similar. He was definitely one of the early people in this area. The people I recommend is a website called truthinequity.com, because I find people kind of understand the concept a little bit, but there's a lot of details to actually pull it off and implement it, and they can kind of help you step by step do it. Just to do a very simple example of how this works. With a traditional 30-year mortgage, you make the same payment for 30 years. All the interest is up front. The first 10 to 15 years, you're making very, very little progress on the principal. And then even worse, if you refinance the mortgage, you start a new 30-year clock all over again. Even though it's a lower interest rate and lower payment, you just threw away all the interest you paid on the previous mortgage to get a lower interest rate and lower payment. So people pay a lot of interest that's really not necessary. So using the mortgage equity optimization model, you use a home equity line of credit, a HELOC as they call it, which is a liquid line. You can put money in, you can take it out, whatever you like. You keep your income, which is normally sitting in the checking account earning zero, in the HELOC, and it's pushing down your balance every day. So you're actually making progress on your principal as opposed to not making any progress for many, many years. And this is on your existing level of income, Brian. You don't need, people say, oh, I need extra income. You don't. It's the way you flow your income that makes a huge difference. And literally, you can pay off a 30-year mortgage, depending on your income, about 5 to 7 years. There's 3 things you need to make this work. You've got to have equity in your house, because if you're underwater in your house, there's nothing to borrow against, so that's not going to work. But you got to have equity in your house. You got to have a decent credit score, maybe 680 or higher, to be able to qualify for the HELOC. And you've got to have positive cash flow during the month. More money coming in than going out, because that cash flow is what's pushing down that principal every day. But I bet the vast majority of the listeners have those 3 things, and literally they could save tens of thousands of dollars in interest and 25 years off their mortgage by using that mortgage optimization system. And again, the people I think are helpful, truthinequity.com.
Yeah, and like I said, I'm a user of a mortgage equity system, and I can tell you that I'm on pace to definitely be off of my mortgage in 5 to 7 years, which is a great thing to do.
What a difference it'll make in people's lives.
It does.
Imagine a 30-year-old couple paying their mortgage off at 35 instead of 60. What a difference is that going to make in their life, right?
No, I mean, I know that people that are coming retirement age, they can retire earlier if they understood this concept. And I noticed you have a chapter in your book that speaks fully about this system. Which book was that? What is that in?
It's called Master Your Debt. The book is called Master Your Debt. And chapter 6 is called Mortgage Free in 5 to 7 years. That's correct. And actually, with the new tax law, it's even more imperative than ever, because lots and lots of people, something like 85% to 90% of people are now not going to be itemizing their taxes. They're going to be taking the standard deduction, meaning mortgage interest deductions are not going to do them any good. Okay, so it makes it even less sense to have lots of mortgage interest and pay, because you're not going to get a deduction for it anyway.
Yeah, can you speak a little bit about that? I'm unaware. I know about the, you can only do $10,000 a year in your property tax. I know that some of the tax changes, but I didn't realize what's going on with the mortgage interest. Can you
okay, so mortgage interest is still deductible. Now they lowered it from $1 million to $750,000.
Okay,
but in order to take mortgage interest deduction, you got to itemize your taxes, right?
Right.
Okay, so they raised the standard deduction for the average family from $12,000 to $24,000, which means that 85 to 90% of Americans now are not going to itemize their taxes. They're going to take the standard deduction.
Okay.
If you take the standard deduction, you're not going to take itemized deductions for mortgage interest or anything else, frankly. Right? So it's even more important to get that mortgage paid off, because you're going to get no tax benefit whatsoever from mortgage interest deductions if you do the standard deduction.
And I also heard, or read that if it's interest off an equity line, that's not going to be tax deductible.
Correct. That is correct.
That should give us a little bit more business in the mortgage world, because people are coming out of their equities are going to want to fix their rates. So we're going to be all over that one.
It's a big one, but you're correct. The tax law that just passed is changing the game dramatically, but it means that deductions are worth even less if you're not taking deductions.
Right.
You're taking standard deduction.
Very interesting. And in Truth and Equity, how much does that system cost? I mean, if someone wanted to get involved.
So they go through a whole process first before they charge you anything to see if you're an appropriate candidate for it. But then if you are, they charge $29.95, just about $3,000, which you'll save in the first 2 or 3 months, to guide you and handhold you all the way through. For example, they help you find the best HELOC anywhere in the country. It's not just your local bank. It could be a credit union. It could be anywhere around the country. You want to get the best possible HELOC, and they can help you do that, and then show you step by step. When you go to that website, truthandequity.com, you fill in a free, what's called a personal profile. You put in your numbers, your mortgage, your income, your expenses, your house value, all those things, and say, okay, what you're doing today is going to take you 28 years to pay off your mortgage. The numbers you just gave us, it'll be 5.6 years, whatever it may be. And they show you exactly month by month how you're paying interest, how you're paying principal. And they've literally changed the lives of thousands of people, getting them out of debt far faster than they ever thought possible.
Jordan, when you say that they are holding your hand the entire
this is
time,
Mr. Jonathan, by the way.
the producer extraordinaire, hidden from camera.
Hi, Jonathan.
Hey, Jordan. When you say they hold your hand, is that a full 5 to 7 years? They stay with you through the whole process.
Correct.
If you have
Lifetime.
questions,
Lifetime. Correct.
And if
I mean,
they want,
the reality of it is, Jonathan, that most people, it takes them a while to kind of get the hang of it.
sure.
After 3 or 4 months, they're kind of into it and they kind of know what to do. But if they ever have questions, so for example, I mean, they've told me all kinds of stories. One of their clients was in a car dealership, and the car dealer was saying, get this 0% financing and all that. It's like, no, don't do that. Don't do that. Because you can do much better, do it through your HELOC, right? Because you can use the HELOC to pay off credit card debt, to pay student loans. It becomes the central financial vehicle of your life. So basically what you sign up, it's free. I mean, it's unlimited use for the rest of your life. And they've helped a lot of people in all kinds of situations.
and if someone couldn't afford the $3,000, they have like a DIY system where you could do it
They do.
yourself.
They do have a do-it-yourself system, which I don't remember what it is, $500, whatever it is.
Okay.
But yes, it
All right.
absolutely. I mean, in theory, that's good. My real life experience is that people need. How does this work? How does where do I move the money? I mean, they need.
Yeah, I'm in the mortgage
Okay.
business. I'm in the mortgage business, and it took me a while to understand this concept.
Right, you're in the business, and so most people are not in the business, and it takes
Right.
a while. It's a mind shift,
Yeah,
and so
it
for some
absolutely
people,
is.
they need a little hand-holding to make that happen. But the main thing is get your mortgage paid off faster, so it costs you $3,000 to save $100,000 or whatever, and 25 years off your mortgage. I think that's worthwhile.
Oh, for sure. All right, so a little bit more about some things that you know a lot about in the real estate industry is you have a website called heroescomefirst.com.
Right. So
And-
there's a lot of savings for heroes, and people don't know about these things. Heroes are defined as military, either retired or current military, first responders, clergy, teachers, doctors, nurses, firemen, anybody in that kind of service field are defined as heroes. Now, they give all the time. They're the ones everybody's rushing out of a building. The firemen are rushing into it, right? Well, here's a way of giving more than just thank you. They can save $2,000 or more on closing costs and interest rates, and they actually get a rebate of part of the real estate agent's commission when you're buying a home or selling a home, if you're considered a hero. And that is the website, heroescomefirst.com. So this is a way of saying more than thank you, but actually giving people a financial thank you for all of what they do. And there's lots of people who are considered heroes who don't know about something like that. So it's
Actually-
a national program.
Yeah, actually, our show next week, we have a realtor and a loan officer that are coming in to promote their Heroes Come First program, basically, Homes for Heroes.
Great.
And what they're going to do is that, there's a lot of realtors that are involved in the program. And as a mortgage company, we also get involved and we find ways to give back to the heroes because it truly is. I mean, they're heroes and they should get a better deal than your
Correct.
normal population for sure.
And they don't know about it. And
Right.
so, you're out there shooting people in Afghanistan or you're running to the World Trade Center or something, you should get something back. So anyway, even if you're not a hero, if you know a hero, you might be able to help them out. Heroescomefirst.com is the website for that.
All right, and then another thing that you promote is people to find a website to actually verify their loan payments. So I get
Right.
questions all the time and saying, how can I get rid of my PMI or my escrow keeps going up. I keep getting letters in the mail. Why is that happening? Or when is my adjustable rate going to adjust? And then you get to look up the closing date and that type of stuff. So can you speak a little bit about
This can all be done
consumers
for
that
you.
have
And
a
there's-
mortgage? Yeah.
There are huge amounts of mistakes on mortgages all the time, Brian. And people don't know it until they can get somebody objective to audit it and see what's going on there. So there's 3 different kinds. The first one is adjustable rate mortgages. So an adjustable rate mortgage is tied to some kind of a rate of some kind. It might be the prime rate, could be LIBOR, could be the national mortgage contract rate, and then there's a spread over that rate. So as rates go up and down, in theory, you're supposed to have your adjustments go right, but in many, many cases, they do it wrong. Say, for example, you got your mortgage with Bank A and they sold it to Bank B. Bank B doesn't know about the Bank A's contract. There's a lot of mistakes all the time in that. And there's a website to help people do that, which is called verifymymortgage.com. So they're going to get your original documents, see what your payments actually have been. And they found people who've overpaid by $8,000, $10,000, $15,000. They get them a rebate of what they've overpaid, and then they get them on the right track so that the payment they're making is correct. So that's the first thing, adjustable rate mortgages. The second one, as you mentioned, is escrow. So escrow is the amount you hold aside as part of your mortgage payment for property taxes and property insurance. Again, many escrows are over withheld much, much more than is necessary. They're going to verify that the actual amount of escrow is what should be withheld, and in many cases give you a rebate or take money back out of the escrow. The website for that, verifymyescrow.com. And the third one is what you said, private mortgage insurance, PMI, is insurance that doesn't insure you, it insures the lenders. I hate paying for insurance that doesn't insure me. It's insuring the lenders against my possible default. Now, typically you need PMI if you have 20% or less equity in the house. But once you get over 20%, you can get rid of that PMI, which can be hundreds of dollars a month, actually. But a lot of people don't know how to do that. So, for example, say you're in a house that's appreciated, okay? You're just sitting there, but the value of the house is much higher and you have 20% equity. Or say you did improvements to the house and made the value of it go up. So it's not just paying down your mortgage. There are other things you can do to get rid of that PMI. But again, you have to kind of do this where you got an appraisal and so on. So the website for that is verifymypmi.com. And they look at the situation, see if there's anything they can do to get you above that 20% mark so you can get rid of that PMI and get rid of these premium payments, which aren't insuring you, they're insuring the lender.
Right, and what a lot of people don't realize is, if you want to waive your escrow account, which is, you don't pay within your mortgage payment, you don't have your taxes or your insurance included, they actually charge us, the borrower, it comes out to be the borrower, is a quarter, because that escrow account must be a moneymaker or some kind of security for the bank or the lender, correct?
Well, the money's sitting there. The bank is using that money to earn money themselves, right?
Yep. So
you're
they're
right.
charging 25 basis points to release the escrow, so it's not included in your payment.
And a lot of banks won't do that. The banks, some of them insist on having an escrow, which is okay. It's a disciplined way of saving up. But I just don't want you to be paying more than you really need to. I mean, they can overestimate what property taxes are going to be, or they can overestimate what insurance is going to be. But when it comes in lower, they don't give you the money back. So,
Are these services free, or are they working off some sort of
charge
commission?
a little bit, depending on which one. Some of them like $200, $300, something like that. I'm willing to pay $200 to save $8,000 or whatever it may be.
Sure.
My mortgage being too high.
Is it $200 before you even get in, and then you pay it no matter what?
They're going to look at your situation first and see if they think if you're a good candidate. And if you are, then they say yes, we think we can save you money. And then they do a very, very detailed analysis, like on the mortgage. Every payment you've ever made, they look at your original contract and then they have all these calculators to say where the rates were and what it should have been. And then the bottom line is you've been overpaying by $8,000. They give you a detailed letter, which you then send to the mortgage lender saying, here's how much I've overpaid. Give me a rebate, and I've got the proof. So it's something the average person could never figure out on their own.
It's pretty awesome.
Yep. Especially you would probably see a much higher success rate with adjustable rate mortgages as opposed to fixed.
Well, it's not going to work on fixed because fixed is fixed.
Exactly. So that would be like on those types of 8,000 savings or 9,000 savings, that would be probably around the areas of adjustable rate mortgages not adjusting correctly.
Correct, because say the index went up or down, they didn't adjust it correctly, or the margin was different. Or there's a lot of things that can go wrong, and most people don't even know there's a problem. Fixing it, right?
Great information. So, one of the things that you also you explain a little and you promote is refinancing your car loan. So as a mortgage company, I know that we help a lot of people look at their car payments and refinance it. Sometimes it actually makes them have the ability now to buy a bigger house because they refinance their car loan. And a lot of people don't realize that when they buy that car, they really didn't shop for rates. They kind of just went into the dealership and they just took what they gave them. And, there's definitely a market for it, right?
Oh, yeah. So a lot of people, particularly in the last 2 years, have taken on much bigger car loans and fancier cars than they really could afford. And the car is great. That's nice. But if it's sinking your budget, that's not a good thing. So there are these ways of refinancing your car loan to a lower interest rate or a lower payment, depending on what you need in your situation, so that you can get the payment down, which eases your budget. As you say, also allows you to qualify for a better mortgage if your car payment is lower. There's a website for that, which is myloangen, G-E-N, myloangen.com. It's a free website. You go in there and you put in everything about your car loan. The amount of the loan, how many more months you have, what the interest rate is, the total amount you owe. And then it says, okay, based on that, it gives you a little dial, and you choose what you want your car payment to be. So say it's $500 and you have 3 years to go. I'm just making this up.
Yeah.
Say if you move from 3 years out to 6 years, your $500 may be $250, right? You can cut your car payment in half by extending out the loan. The cars today are very good. They tend to last a long time anyway. So now you've just made room in your budget and still get to keep your car, offered at a lower interest rate. And then once you pick exactly the payment that you can afford, you hit submit, and that goes to credit unions around the country who compete for your business to get you the best deal on a car loan. So a lot of people, and you're certainly not going to hear about this from your car dealer because they make money on the car loans all the time. But this is taking it out of the car dealership into the credit union world, saving you a ton of money on refinancing your car. And again, the website myloangen.com. Particularly in this area, there's been a lot of subprime car loans made. People in the past probably couldn't have gotten car loans, have at very high interest rates, 15, 16%, something like that. Now, the reason that the lenders are willing to make these subprime car loans they didn't in the past is because they put a device in your car that if you don't make your payment, they can turn your car off, disable it wherever you are. You're driving along Route 95, and all of a sudden your car dies. Oh, I didn't make my payment. I wonder about that.
I would hope they have some kind of device that says the car can't be running.
No. Your car is running, and your car dies in the middle of wherever you are. Okay, and then of course they have a GPS, so they know exactly where to send the repo man to pick up your car.
Jeez.
So that has given the lenders confidence to make loans that in the past they wouldn't have made because they had all these TV shows, the guy goes with a shotgun in the middle of the night to take your car. They don't like that kind of thing.
Yeah, I love that. I love that show.
This makes it much easier to go repossess the car. You just disable the thing, and you go and pick it up. So because of that, a lot of people have gotten car loans that probably in the past they would not have at very high interest rates.
I love.
So there you go. Now we've refinanced your car loan.
I love the ones when they repo like a Lamborghini.
Right.
But the owners don't normally let go very simply.
Yeah,
easily.
right. Exactly.
They've got shotguns too. It's all this drama. This takes all the drama out of it. But I'm just saying that people have gotten in over their heads in car loans they really shouldn't have done, and this can help them. And as you say, if they get their car loan payment down, that helps them qualify for a better or bigger mortgage.
Yeah, I try to tell everybody, a car's not an asset. People think it's an asset. It's a liability. And unless you're going to rent it out to, you're going to be an Uber driver or a self-driving car, you're going to give them space in your car or something like that.
A car is a depreciating asset.
Right.
I don't know how fast it's going to depreciate. But I like to say lease things that depreciate, buy things that appreciate, like real estate or stocks or something like that. You don't want money tied up in a depreciating asset, which for the most part is what cars are.
So Jordan, let's talk a little bit about the economy. I mean, the economy's obviously doing very well right now. Our president probably thinks it's because of him, but the economy's doing very well. I mean, what happens if this economy kind of flips around? I mean, where's the way to earn significant profits when times become tough?
Well, I mean, there are lots of things you can do. I did a book, as you mentioned, called Fast Profits in Hard Times. There are ways to make money in hard times. We're not in hard times now,
right.
But there are lots of ways. I'll give you something in the real estate field that makes a lot of sense, which is tax liens and deeds. So when people don't pay their property taxes on time, the local municipality puts a lien on their house, a tax lien, which is then sold to investors. And when people do pay their property taxes later, they pay that plus a penalty. Each state has a different amount of what it could be, like 8% to as much as 25% in Texas, for example. So that's something that the average person can do. Doesn't have to be a huge amount of money. where you can earn between 8 and 25%. You just don't know when you're going to get paid back. That's all.
Right, and if
So
that person doesn't end up paying those taxes, you actually get the house.
You have the rights to that house.
You have the rights to that house.
You're in first position because a tax lien is ahead of any other mortgage. So say the guy doesn't pay his taxes. Typically after a 2-year period, you have to pay the property taxes for 2 years. If he doesn't pay the property taxes then, yes, you have the right to foreclose. And then you in effect buy the house for the amount of the property taxes. Say the property taxes are $5,000 a year. So you pay $10,000 and you can end up buying a house worth $200,000 for $10,000 in effect. And then you sell it for $100,000, whatever it may be. And now that doesn't happen that often. People tend to like to hold on to their homes.
Yeah.
But that's the upside with the tax lien strategy is actually buying the home and then be able to resell it at a big profit.
Yeah, I saw an infomercial on that too as well.
Well, it can be done right. You got to know what you're doing.
It can be done right.
But that's an example of a strategy that does well, even if the economy is not doing well.
Especially
but right now,
like in 2000, like in 2008, probably a lot of people picked up some property that way.
Correct.
Yeah, for sure.
Correct.
So, Jonathan, do you have a question?
No, I'm good.
All right, good. All right. So Jordan, the current economic outlook. I mean, really, so many different people predict what's going to happen or where we're at. But how do you see the economics today in this country?
It's going to be a very strong year. 2018, we're going to have over 3% GDP growth. The stock market's going to keep doing very, very well. As the tax reform kind of works its way into the economy, it's going to be very stimulative. On the individual side, as we said, the standard deduction is going to double. A lot of people aren't going to itemize. Think of it as the first $24,000 in income being tax-free. Kind of think of it that way. So that means that a lot of people are going to have extra income to go out and spend or save or invest one way or the other.
And that's your standard deduction for a married couple, basically, is it $24,000?
$24,000 used to be $12,000.
Gotcha.
Correct. That's been doubled. And for individuals, it went from $6,000 to $12,000.
Okay.
So lots and lots of people are knocking on it, which means they're going to be simplified, filling out their taxes as well.
Yeah.
So that's on the individual side. Also, tax rates have come down. So that means you're going to get to keep more money in your paycheck. And starting in February, you're going to actually see more money in your paycheck. Now, the vast majority of the dollars of the tax reform are going to be going to higher income people. Yeah. Middle income, lower income people are going to get a break. It'll be something. They might get $2,000 or $3,000 in a year. Higher income people might get $100,000. So, I mean, the dollars are much bigger for higher income people. The other big impact of the tax reform is going to be on corporations. They were paying 35%. Now they're going to pay 21% on taxes. Their profitability, nothing else changing, just went up dramatically. So the question is, what are they going to do with that extra profitability? There's 3 things they can do. They can invest in the business, hire people, new plants and equipment, raise wages, capital expenditures. They can buy back stock, and they can raise dividends. All 3 of them are good. Okay. Yep. Some companies will do some more. Right after the tax reform was passed, quite a few major companies, Comcast, Federal Express, Wells Fargo, gave people a $1,000 raise and raised wages across the board, and they said they're going to do capital expenditures. That's all very, very positive for the economy. But even if they buy back stock and raise dividends, that's good for stockholders as well. So all these things are kind of turbo boosting the economy that had already been growing at 2.5%. And I think it's going to do very, very well. My only concern, the only thing that could kind of upset the apple cart here is a major geopolitical event, meaning war with North Korea.
Yeah, North Korea.
Or a Middle East war. Israel and Saudi Arabia and Iran, the whole kind of volatile mix. Right now, they're screaming at each other, but they're not shooting at each other yet.
Well, hopefully it's not going to come to shooting at each other.
And the same thing with North Korea. I mean, we're screaming at each other and saying all kinds of things, but those are the only 2 things I can see could really upset the apple cart. But if we don't have wars, I think the economy, and not only domestically, but it's going on Japan and China and Europe, it's growing all over the place. So, I'm very, very positive for this.
So if no geopolitical risk, if that kind of went away, do you see interest rates kind of ticking up and lending rates?
A little bit.
Yeah, a little bit.
The Fed Reserve raised rates 3 times in 2017. I think they'll probably raise them 3 more times, which means that the rate that they control, which is called the Fed funds rate, is now 1.5%. If they raised it 3 more times at a quarter each, that would mean the end of the year at 2.25%. The prime rate is based on that, so the prime rate today is basically 4.5. That would go up to 5.25, which is higher than it had been, but still relatively low for the economy growing this fast.
Which would be good for banks. Banks should
Banks are going to do very well because banks are raising what they're charging, but not raising what they're paying. Right. As we talked about at the beginning, if you keep your money in the bank, you're going to keep earning zero. Even though they're earning more, they feel under no obligation to raise what they're paying. So, yes, bank stocks have done very well because their profit margins are widening just by sitting there.
I know. They make money in spite of themselves.
They do. They do.
So, Jordan, I know this is probably off topic, but what do you think about cryptocurrencies? I know that it's been like a huge buzzword.
I'm very big on cryptocurrencies. Right. I'm very big on this. I'm involved in them too. It's not going away. They're very volatile moment to moment, but I think you got to be playing in the game. A very simple way for the average person to do it without getting into the complications of it. There's a stock which is called Bitcoin Investment Trust. The symbol for that is GBTC. That started 2017 at about $200 a share. Last I looked, it was about $3,000 a share. Okay, it's gone up a lot, and that's a pure play on Bitcoin.
I bought that at its height. It's come down a little bit, but I'm waiting
it's
for it to come back.
It's going to be very volatile. But I mean, in the case of Bitcoin, it's limited as to the number of coins. I think it's 16 million now, something like that.
16 million coins.
16 million coins. But the demand is huge, not only from America, but Korea and Japan and China and India. There's all over the world. There's tremendous demand. So, yes, very volatile day to day, but I think going up much higher. If you don't want to do Bitcoin, I call Bitcoin the gold of cryptocurrencies. It's kind of the flagship. Yeah. But there's lots of other ones. There's Ethereum. There's one called Bitcoin Cash. The new one that's coming up is called Ripple. It's very hot right now. So
Litecoin hasn't been.
Litecoin. There's a whole bunch of these things. Yeah. So this is a whole new. This is going to be one of the major stories of 2018. I don't want your listeners just to be sitting on the sidelines. You got to learn to play these things. There are these exchanges. There's something called Coinbase. There's another one called Bitstamp, where you can kind of get in and then buy several different cryptocurrencies from those things.
Yeah, so I subscribe to Coinbase, and there's 4 that they offer. They only offer to buy it direct, which is Bitcoin, Bitcoin Cash, Ethereum, and Litecoin. Eventually, hopefully, they'll have a couple more that are coming out. I know IOTA is another one. I've been really reading up on this stuff. But, the question's going to be is all these millennials, right? I mean, everybody – we did a show not too long ago about gold. And, he's a leading person in the industry. And he said, a millennial's really going to buy gold like our parents did and our generation. They're going to probably buy – this is the new gold, right? So – it's supply and demand, and that's why I believe that I'm going to kind of stay the course.
Can you guys answer me one question?
Yeah.
How the hell do you spend cryptocurrency?
You convert it back. I mean, first of all, you can actually use Bitcoin to buy real things. McDonald's said they're going to start taking Bitcoin at the counter in 2018. So more and more people are buying homes with Bitcoin. I mean, there are actual ways to do transactions in Bitcoin.
I seen a house in New York that they would only take a purchase through Bitcoin. Like they're trying to, because they really want to make it more.
That is what's happening. Correct. So I mean that's coming, but you can also convert it. What people in the crypto world call traditional currency, they call it fiats or fiat currency. Yeah. So you can convert your cryptos back to fiats, which is the way you're normally used to, and then spend it that way. I mean, with Coinbase or something like that, you can switch money back and forth between the cryptos and the fiats. So, yes, you could take money out and spend it. Absolutely. But more and more, you're going to be able to buy things in actual cryptocurrencies like Bitcoin.
I'll be able to get my double wide.
Mr. Jonathan, he's a minimalist. He just wants to get a double wide and, live his life as a minimalist.
Well, buy it with Bitcoin. Why you're double wide with Bitcoin? Yes.
All right, I'm in.
The growth. Jordan, I just want to say thank you for coming on our show. It's been a really interesting 40 minutes or so. And, if anyone wants to learn more about Jordan Goodman, you go to moneyanswers.com.
Right. That's my website. I've got lots of resources, links. Take emails from people. I do a podcast called The Money Answer Show. So just giving you a sample of some of the resources. I mean, just think of what we've done in the past little while here, Brian. We've helped people earn 8% on their money with the secured real estate funds, helped them pay their mortgage off in 5 to 7 years with optimization, given people who are heroes big rebates on their mortgages, verified all their loan payments, helped them refinance their car loans. I mean, these can make a major difference in people's lives. So hopefully it'll be helpful to a lot of you.
They need to take the first step. They need to learn about it, and then they need to figure out, what their next step is. I mean, I know that I'm going to be looking into this pretty much right after the show. We're in the middle of a snowstorm. So, We have plenty
Yeah,
of
we
time.
got plenty of time on our hands.
Excellent. Very well. Thanks so much. I really enjoyed being on with both of you, and glad to help you listeners if they contact me at moneyanswers.com.
Thank you, Jordan.
Thank you.
All right, I guess that's a wrap.
That's a wrap.
And as we say in the industry,
There's no such thing as easy money.
that's
If
right.
there is, give us a call. Let us know about it.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.